Waiting for Pam to get in here. You should be able to hear me this time, Pam. Hey, Pam, can you hear me now?
Yes, I can. Good morning.
Good morning. Boy, I tell you, that is so annoying. I don't know why that microphone conks out. Are you a court reporter, by the way?
I am, yes.
Who do you report for?
How did you know that?
It says in your
Oh, my response? There we go. Yeah, I think it was in a discussion I said that, yes. Well, I do depositions. So I do freelance. And yeah.
wow, depositions. You don't really see much conflict in those, do you?
Not at all.
All right. All right. Enough of the idle chatter. You ready to go to work here? Let's see what we have.
Yeah. By the way, I probably have to step out at some point. And are we the only two people here?
It's ridiculous. Yeah, you're the only. I'll check the roster, see if we've scared everybody away. Yeah, hold on, please. Let's see here.
Yeah. I think we are the only two here.
Yeah, so far.
Okay.
I'm just bringing up the slide here. Oh, everything is slow.
Come here, Chloe. Good girl. Come on. Come on. You gonna come in?
Where did my audience go?
Sorry, I'm trying to corral my dog.
Oh yeah, let's see the guy. He's all right.
She's running around, so.
All right. Okay, Pam, you can see the slide now, right?
Yes.
Okay.
By the way, do you want to tell me do you want me to just tell you if I have to step out?
Yeah, just let me know.
Okay.
Just say I have to leave.
Okay.
Because I guess we got a one-on-one going, which is, I guess,
yeah. It's fine. Yeah.
Better than a two-on-one, huh?
I thought I had a good handle on chapter 2, but I didn't do that well on the quiz. So.
Oh, really? Okay.
But I didn't. I started it late last night, so I wasn't able to finish the last question. So that's what happened.
Yeah, get those debits and credit rules under your skull. Nothing more important than that right now.
I did make good notes on it, so I do have notes. Yeah.
Excellent. Okay. I guess we're going to talk a little bit about accrual accounting, which is what we are doing in this course. We teach accrual accounting.
Okay.
It is the only GAAP approved system. And what it means is that revenues and expenses are recorded at the time they occur and have nothing to do with whether the bill is paid or not. Okay? So the recording of the revenue and the expense doesn't necessarily follow the cash.
Okay.
Accrual basis, revenues are recorded when products or services are delivered, expenses when incurred. Cash basis, you'll cash basis yourself out of business if you're a bigger business and you want to fool with a cash basis. You won't get any questions on a cash basis on the test, okay? only accrual basis accounts can be audited and verified, okay?
Mhm.
And I don't think we want to. Okay, here we go. We're getting into what is called, this is a little tricky area now we're getting into. We're going to get into something called, looks like adjusting journal entries on an accrual basis. We went out and we bought an insurance policy for $1,200. Or rather, if you see it on the left here, $2,400 for an insurance policy that lasts 2 years.
Okay.
At the
So
time of the
prepaid.
go ahead.
So
At the
prepaid.
prepaid, there we go, exactly right. We bought an insurance policy would have to be prepaid, right? If you think about it.
Yeah.
You have an accident, then you buy the policy. No, I'm
Yeah.
sorry, I'm being a little silly in the morning here. We paid $2,400 for an insurance policy that's going to provide benefits for 24 months. At the time of the purchase, that insurance policy is an asset. It's called a current asset. What we will be doing, though, over the next 24 months is we're going to be reducing this asset to recognize the use of the coverage, the fact that we have coverage. So this policy begins December 1, 2021. At the end of December, we acknowledged that we had coverage, insurance coverage of $100. Same thing for the next year, and then the next year, first 11 months. Okay, make a little bit of sense, Pam?
Yeah.
Buying it and then spreading it out later, huh?
Right.
We're not going to get into cash basis, revenue recognition. You're gonna hear this like crazy. The next chapter is up. Revenue recognition principle. Revenues are recorded when you make the sale or provide the service. You're a court reporter, and somebody comes to you for your services, and they pay you. They contract you to do some work. You go to a deposition, you do your work, but they're not going to pay you for 60 days. You made a deal with them.
Right.
Your company earned that revenue that month, and that's
Okay.
considered a sale for that month. Okay.
Okay.
Same thing with expenses as they're incurred. Now we're going to get into adjusting journal entries. Ooh, adjusting journal entries. At the end of the month, you're going to run a trial balance. That trial balance at the end of the month, by definition, is wrong. It is incomplete because there are certain transactions that can only be recorded at the end of the month. And these are internal type transactions. So let's take a peek at it. We're going to determine what the balance of the current asset should be, what the expense is. And let's go from here to here. Deferral of expenses. You have accruals, you have deferrals. Deferred expense, deferred revenue, accrued expense, accrued revenue. Deferral means that money changed hands, but nobody's earned anything yet. Money has changed hands, but nothing's happened. For example, prepaid insurance, prepaid rent, prepaid supplies. When you bought the asset, when you bought that insurance policy, you debited the asset, $2,400, and you credited cash perhaps or accounts payable. And then every month for the next 24 months, you're going to reduce this asset by $100, recognizing the commensurate $100 expense. Fast forward, pay $2,400. There's what we did at the beginning of the when we got the bill from the insurance company. Now we're at the end of December. The policy began December 1st. We paid for it probably in November. So we have to make an adjusting journal entry. Here is your adjusting journal entry. Insurance expense is debited $100 to recognize the amount of insurance coverage, and the asset is commensurate, is reduced, is credited for 100, and the balance is now 2,300. At the end of next month, the balance is going to be 2,200, 21, etc., until you get it down to zero. It's called a prepaid expense. It is an example of a deferred expense. And here's another look at it here. Here is the adjusting entry. We debit the expense. Expenses go up with a debit. And the balance sheet shows us that the asset is now down to $2,300. Okay. Prepaid insurance. Boy, they love to talk about prepaid insurance, huh? Prepaid insurance. Here it is again, general ledger. Oh, I'm sorry, I hit the wrong button. Prepaid insurance. We bought it December 1st. We used $100 of it by the end of December. And there's your journal entry. Okay. This makes sense intuitively, Pam, what we're trying to do?
Yep, it does.
Okay, well, continue along. And we might do the same thing with supplies. When you buy supplies, they are not an expense at the time of purchase. They're an asset to be consumed later. And when consumed, that becomes the expense. So fast forward, bought $9,720 worth of supplies. At the end of the month, they went out and they counted the supplies, okay? They went out and they counted the cleaning supplies or whatever it was. So we bought the supplies, $9,720. It is an asset. Look at your adjusting entry, $1,050.
Yeah.
$1,050, huh? We purchased $97.20, and then we went out and counted the supplies, $86.70. The difference is $10.50 that we used. And it's the same thought process. The balance sheet goes down to $86.70. Supplies expense goes up. Now, I've had more than a few students say, wait a minute, we buy supplies at our place. You know, we buy staples and we buy adding machine tape and we buy cleaner. We never count these supplies. What we're talking about is a larger operation here.
Okay.
You know, like
so if it was small, like say for me, because as a sole proprietor, then it would be like I bought some staples. That's an expense. That's what
you would expense it as soon as you buy it. We're talking about a larger organization like Nordstrom's, where they might buy 3 months worth of boxes or something for their customers. Supplies. We've seen the adjustment in the T accounts. And here we go. There's your general ledger. Hello, general ledger. Debit, supplies expense. And you realize now you have all kinds of prepaids. Prepaid insurance, supplies, taxes, whatever you think of. Although in this course, you're not going to get a question other than supplies or insurance.
Okay.
Hey, let's talk about depreciation. Depreciation. This is the adjusting journal entry you should pray I put on the test, because this one is ultimately, I think, the easy one.
Yeah, okay.
We went out and we bought a plant asset. What's a plant asset? It's a piece of equipment that's going to last for many years. A big ticket item. A truck, a building, okay? Big stuff. And what we need to do is spread out the cost of that item over the life of the asset, the useful life, which is an accounting term. Say hello to straight line depreciation. In 3 more chapters, we got a whole, we have an entire chapter dedicated to fixed assets. But for here, straight line depreciation. What you do is you take the cost of the asset, you divide it by the useful life to get the annual or monthly, if you will, depreciation. Keeping in mind, if there's any salvage value, and I'll talk about that in a moment, salvage value does not get depreciated a little tiny complication. Here we go. Fast forward, bought equipment, $26,000. They think this asset will last 5 years. So they're coming up with an estimated useful life. It has to be a reasonable estimate, though. It's called systematic and rational in accounting. It has to make some sense. The equipment has a, wow, look at the salvage value. The equipment is expected to be worth about $8,000 at the end of 5 years. So they bought this thing on December 1st. Now we're at the end of the year. 26,000 minus the 8,000. Minus the 8,000 because we do not depreciate the salvage value. The net cost, also more likely called the net book value number here, which is the original cost minus the accumulated depreciation. You can never have the book value go below the salvage value. Something for the future. Let's see what we have here. Somebody bought equipment, $8,000 at the end. 26 minus 8 is 18. The next 60 months, that's $300 a month. $300 a month in depreciation expense. Now, why do I say this one's easy? Because it's always the same debit and credit. It's always a debit to depreciation expense and a credit to an account called accumulated depreciation. The amount of 300 is credited to accumulated depreciation instead of the original asset. You see that equipment number there, 26,000, Pam?
Yeah.
You don't see it now, but the 26,000, you will never credit that number. You will never reduce that number unless you actually sell the asset.
Okay.
What you are going to do, though, is increase this account called accumulated depreciation. Accumulated depreciation is what's called a contra account. Contra, from the Spanish word meaning contra, okay? It is a contra asset account in that it increases with a credit balance. It's an outlier. The difference between the original cost and the accumulated depreciation is going to be your net book value. So here's your journal entry. We debit the expense 300, credit accumulated depreciation. And if you wanted to get ahead, you could write the next 60 journal entries in advance right now. Debit depreciation expense, credit accumulated depreciation. Hi, Benicia, how you doing?
I'm good. How are you?
All right, we're just starting off. We're just starting off with some adjusting journal entries that can only be done at month end. Depreciation expense, and this is the important point that I wanted to make, everybody. Equipment 26 minus the 900 book of accumulated depreciation. There's your net book value, 25,100. And that's how it's going to look on your balance sheet. Investors who really dig into the numbers, they want to see what kind of big ticket items you have there. And the first thing they're going to be looking for is that net number. On February 28th, after 3 months, the equipment is now down to 25,100. Again, it looks like the same exact slide, no? Yeah. Anyway, they're just puffing it up a little bit. Deferral of revenues. Deferral. What we decided, Benicia, is we have deferred entries and accrued entries. Deferred entries, deferred revenues means that the service was postponed, if you will. I don't want to use the word postponed, it was scheduled for later. A deferred journal entry means that money changed hands, but nobody's done anything yet. And that's an important concept. Okay. We just did a couple of deferred expenses, okay? Deferred expense. Look at a new one now. Unearned revenue. Unearned revenue. That's cash we receive in advance of providing our product. You're a lawyer, Ebenezer. Somebody comes to you and they sit down with you and they say they want a will drawn up or something. And you say, that's good, give me $10,000, and then next week I'll start on it. Well, what you are going to do is you're going to debit cash, of course, debit cash to increase it, and you're going to credit this account called unearned revenue. Unearned revenue is a liability account. Unearned revenue is a liability account, believe it or not. You don't owe that client money. You owe the service that they paid for you to render. Okay? So fast forward, earns payments as time passes. At 12/31, I hate the way they said this particular slide. Fast forward's client paid a 60-day fee in advance, covering 12/27 to 2/24. At the end of the year, fast forward did do some work. They did $250 worth of work. They can now claim that $250 as revenue. Here is the original receipt of the cash. You debit cash and you credit that liability account, unearned revenue. And here we go. Let's take a look at it. We had 3,000 in unearned revenue, representing the payment we got. On the 31st, we recognized 250 as work we did. Work we did. So now we can debit the liability account called unearned revenue. I'm sorry, I got happy fingers here. And credit consulting revenue. Debit 250, credit 250, and that's where we stand at the end of the month. We have a liability remaining of $27.50, and that $250 just gets layered into our income statement. Unearned revenue. Unearned revenue. Another example of unearned revenue is I'm a big sports fan. I send the Dodgers my $50,000 every year for my season tickets at Dodger Stadium. When the Dodgers get my money, it's January. They don't play baseball till April. When they get my money, they debit cash. Thank you, Bob, for the money. And they credit unearned ticket revenue. The baseball season is 6 months starting in April. At the end of the first month, they record the appropriate amount of income. Now, we just went through deferred expenses. And Ebenezer, you got here a little bit late, but we'll cover it here. Did you notice, Pam, one thing, that the unearned revenue is the same thing as a prepaid?
Yeah.
In other words, depending on what side of the transaction you are. If you're the insurance company and you sold the policy, to you, that's unearned revenue. You bought the policy, to you, it's a prepaid expense. Same thing. Accrued expenses. Accrued. You're going to hear the word accrued a long time. Accrued expenses. We are going to record expenses when they occur and have nothing to do with the cash. In fact, some of these expenses that we're going to record might be an estimate. We might not even have the bill yet, but we still have to recognize the expense. So we're going to accrued expenses are costs involved that are unpaid and unrecorded. Ooh. Here, they're just giving you a boilerplate. You debit an expense, credit a payable of some kind, liability. So let's see if we got some examples here. Oh, here's one you might understand right away. Salary accrual. And let me get a little snort going here real quick. Whoa, that's good booze. Hey, Pam,
Yes,
I'm going to digress. Are you familiar with Jackie Gleason,
an actor?
the
Is that who you're talking-
comedian actor? Yeah,
Yes, yeah, I'm of that age, yeah.
he was wonderful. None of the younger students never heard of the guy. It drives me nuts. Anyway, that was one of his shticks with the coffee.
Oh,
Okay. Anyway, fast forward, pays its one employee, I guess, $70 a day or $350 a week. Now take a peek here. 12/31 is a Wednesday. When this person goes home that day, they're not going to get paid for that day yet. Payday might not be for 1 or 2 weeks, but they worked how many days in December? They worked the 30th, the 29th, the 30th, and the 31st. They worked those 3 days. We have to recognize those 3 days, $70 a day times 3, as an expense an expense in December. Here's your journal entry. You debit the expense and you credit the payable. And we got another presentation here. Your T accounts. Salaries expense 210. The 700 you see there and the 700 you see there represent the salaries that have already been paid and processed during the month. And these people get paid every 2 weeks. So even though you earned these 3 days in the month of December, you're not going to get paid until January 14th or something. Balance sheet will show that we owe 210, and the expenses have now risen to 1610. That's an example of an accrual. You can have accrued salaries, accrued taxes, all kinds of accruals. Accrued expenses at the end of one period are going to result in a cash payment in the future. Fast forward, recorded that $210 worth of salaries. On 1/9 of the next year, we have to reduce that liability and record the full payroll. So there's a little bit of tricky here. So let's go through this. We have a payroll every 2 weeks of $700. So we just wrote out a check for $700 and you handed it to your employee. We have to record that payroll. Do you remember 3 days of this pay period were worked in December? Remember, we set up this payable 3 times 70. That was the balance, 370. So now we're going to debit the payable to bring it to 0. And the other 7 days are an expense. They were worked in January, which is what we're recording right now. Make a little bit of sense, guys? We want to record the expense for the days you actually work. Has nothing to do with whether you've been paid or not. We can do the same thing for revenues, sales. Typically, interest income is what we're talking here. Accrued revenues are revenues earned that are both unrecorded, unpaid. We're talking mostly about a lending situation. We loaned somebody money on, I don't know, say December, and we loaned them money for 2 years, $2,400. And the deal is they don't have to do anything in terms of paying us back for 2 years, but we have to record interest expense. So let's see what we have here. Fast Forward's customer agreed to pay $2,700 have been. I've been arguing with the publisher. This is not an adjusting entry. I don't know why they call it an adjust. This is your basic debit accounts receivable credit revenue. This is what you were doing in chapter 2. So I'm going to go past this here and get the real meat on the bone here. Oh, come on now. That's crazy. All right. This here is a good little screen to help you study a little bit. Remember, we have deferrals and accruals. Deferrals, money changed hands. Nobody did anything. We can defer an expense or a revenue, and there's your journal entry. And then they're making you think a little bit, where it says before adjusting, before we recorded that journal entry, your expenses were understated and your asset was overstated. Accruals, no cash involved. We're going to debit an expense and credit a liability. Or if it's on the revenue side, we're going to credit a revenue and debit and expense, okay? Good little screen to have in front of you. Prepare financial statements rather, from an adjusted trial balance. Oh, look at this worksheet. This worksheet eventually expands to 10 columns. But let's take a look at it here. The month is ended. The month is ended, and you came into work early the next morning because you know you're going to be busy in accounting preparing financial statements for the next couple of days. You run a trial balance. And a trial balance only does one thing that's accurate, and that is it demonstrates that the debits equal the credits, okay? That is something you're never going to have to worry about in your world. No computer system is ever going to let you knock the accounting equation out of balance. In the old days, when I had to do this in pencil, yeah, if you made a mistake. Unadjusted trial balance. Now look at this. Look at this. We have some journal entries. Journal entries. This was before you came here, Ebonisha, but take a peek. Remember this one, Pam, the $10.50 for supplies? We debit supplies expense, $10.50, and we reduce the asset $10.50. We increase supplies expense, which was $0, and that makes sense because we can't record the supplies expense until we count them, maybe at month end. So our balance has gone from 0 to $10.50. This is the new correct trial balance. Prepaid insurance. I'm so sorry, this thing is loose. We debit insurance expense for 100. Balance was 0. And we reduced the 2,400 to 23. Let's take a peek at the accumulated depreciation. The accumulated depreciation, we debit the expense, 300, and that's why I say depreciation expense is the easiest adjusting entry, because it's always a debit to expense and a credit to the prepaid. Hey, what kind of pooch you got there?
She's a golden doodle.
Beautiful dog.
Thank you.
What a popular breed around town, huh?
Yeah. There we go.
Nice looking animal. I'm the eccentric old man of Santa Barbara, I'm afraid. Whenever I'm walking around, I see somebody with a dog, I have to make a wisecrack. Somebody walking a dog like that, and I'll say something like, "Can I safely walk past this vicious-looking animal?" People love it when you talk about their dog. Okay.
Yeah, for sure.
Okay, so what have we done here? We ran a trial balance, which we know by definition is incomplete. That's the whole point of chapter 3. We prepare the adjusting journal entries and come up with the new adjusted trial balance. Now we can use these two columns to do financials if we wish. Steps for preparing from the adjusted trial balance. Oh my goodness. Prepare the income statement using revenue and expenses, statement of retained earnings. Yeah, that's what we got to do, all right. Income statement, retained earnings statement, balance sheet, and cash flows. All right. Step 1, they're saying, huh? Do the income statement. Well, let's look at our trial balance. And this is super important. I'm pretty sure I mentioned it. You see where it says consulting revenue 7850? Go to your first revenue item. The trial balance will be in order of the chart of accounts. You're going to have assets, liabilities, equity, and now consulting revenue. If you put a line above that 7850, everything below the line is your income statement. It's that easy. Take a peek. Well, we know our income statement starts here, and they set this income statement up. They're showing a revenues colon. I see a colon there. It's just a header. They have 2 types of revenue: rental and consulting. They add them up and they get 8150. And where did they get all these expenses? Just copied them right down. So this company made a nice profit, it looks like, of $37.85. Okay. Sales minus your expenses right here. We have to do the income statement first. And I guarantee that'll be a question on the test. They'll give you a question where they want you to tell them the sequence of the closing statements, and it's always the same: income statement, retained earnings statement, and balance sheet. They have to be done in that order. The reason that we did the income statement first is because whatever the net income is going to come down to the statement of retained earnings. Statement of retained earnings. Don't be afraid of it. Students tend to get a little nervous about it. It's not too bad. Statement of retained earnings. Your beginning balance plus net income minus dividends equals the ending balance. Bide your time. You know that expression, bide your time, BIDE, beginning, income, dividends, ending. So let's take a look at the retained earnings statement. There was no retained earnings because this was a brand new company. So their beginning balance was 0. They made this wonderful profit of $37.85 and decided that they could pay a couple of $100 in dividends. So the equity of the company is now $35.85. All right. Now that we have the new retained earnings number, we can do the balance sheet. And remember, everything starting with the 7850, the consulting line, is your income statement. Everything above it is the balance sheet. So all you had to do here is copy all the numbers down to dividends and then insert the new balance for retained earnings. And that's the process. Income statement is done first because it feeds the retained earnings statements, which roll into the balance sheet. Roll into the balance sheet. Adjusting journal entries. Now, did you take a 110, Pam, by any chance?
No,
Did you take 110, Ebenetia?
Yes.
Okay, so this is a little bit familiar to you, I would hope, right? You remember this a little bit?
Yeah.
Okay, good to hear. All right, here we go. Closing entries. Now, if this was 110, we have a whole chapter just on the adjusting entries. Here in 230, it's just a piece of it. Closing entries. We just did adjusting entries. Now we have to do closing entries. What we're doing here is we're taking that net income of whatever it was, 3585, and we're going to update capital. We're going to increase retained earnings. Let us take a look here. Closing process. Reset the revenues, expenses, and dividends. Move it into retained earnings, blah, blah, blah. Let me go ahead here. We have temporary accounts and permanent accounts. Temporary accounts are the ones we close. How do we know if it's a temporary account? Because it's on the income statement. Any account that appears on the income statement gets closed into equity at month end. We're talking revenues and expenses, and we had some dividends here. Revenues and expenses. What are the permanent accounts? The permanent accounts are everything on the balance sheet. Permanent accounts, assets, liabilities, equity. They go on forever. They never go away. They're here forever as long as the company exists. You don't close cash at month end. You have a balance of $100. Next month, the balance is something else. So the closing process only to the temporaries, and the temporary accounts are the income statement. Now, here is a real good summary of what we're going to do. Four steps. Actually, you can do this in one step if you really feel you understand it. But step one, close the credit balances in the revenue accounts. What do we mean by closing the revenue account? We mean debiting it so that the new balance is zero. Close the debit balances in the expense accounts. They have a normal debit balance. We are going to credit them to get all the expenses down to zero. And we're going to do it through an account called income summary. Just a closing account. You'll never see it on your financials. So think about it. We put the sales into income summary, and then we put the expenses into income summary. At that point, the income summary balance equals your net income. And then we're going to zero that account out to retained earnings. And the last one, we close dividends. Okay, maybe get a little clearer look at it here. What are the temporary accounts? Revenues and expenses. Revenue accounts, we have 7850, 300, right? We will zero out the 7850 with a credit, with a debit rather, with a debit. And we'll zero out this balance, the rental revenue, 300, that's 8150. There's your debit, there's your credit, income summary. Income summary at that point has a balance equal to your sales, equal to your revenues. We do the same thing with the expenses, which all have debit balances. We credit them to bring them all to zero, and we add them up, and it turns out they add up to 4365. So now we have zero revenues, we have zero expenses, and we've moved that money into the income summary. Income summary. Step three, we close the income summary, which equals the net income to retained earnings. and dividends get closed to retained earnings. Dividends is not a temporary, but we don't want to show dividends on the financial statements. That's nobody's business, really. Let me talk a bit about retained earnings. Balance was zero at the beginning, huh? The reason the balance was zero at the beginning is because it was a new business. They made a profit of 37, I'm sorry, what was it, 35, blah, 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 where's the profit here? 37.85. They made a profit of 37.85. So that brought the retained earnings balance up to 35.85 after we account for the dividend. Next month, maybe they make a profit of 10,000. Your retained earnings would then be 10,003. It would be 13,785. They earned another 20,000. So you get the idea. Retained earnings is a component of equity where you record the net income every month for your company from the day it began. If there were no dividends, the retained earnings balance would be the total net income since your great-grandfather set this company up in World War II. Okay? And after that, we've gotten rid of the revenues and expenses. So we want to run one more trial balance. One more trial balance. And here it is. Post-closing trial balance. I see assets, I see liabilities, and I see equity. What don't I see? I don't see the revenues or the expenses because we zeroed them out and moved them over here to retained earnings. Okay? Closing. This is a good screen right here. I think this makes it pretty clear. Have that in front of you when you're trying to do your homework. Oh my goodness, the accounting cycle. Believe it or not, we've gone through the whole accounting cycle. In chapter 1, we went through the accounting equation, right? We showed you how cash goes up or down, assets go up or down. Revenues can only go up. Expenses can only go up. Analyze transactions. The next chapter, we learned about journalizing, writing journal entries and posting them and preparing the trial balance. And that's where we cut off after chapter 2. Part 5 is what we just learned here. Part 5, we learned that trial balance is incomplete, requiring adjustment. We adjust and post. We prepare an adjusted trial balance. And from that, we do the income statements. And then we close and then run the post-closing trial balance. Whether you're a small flower shop on Delavina or your General Motors, it's basically the same thing, the same process, okay? Classified balance sheet. Classified balance sheet. That's a fancy word for saying we're going to break it out into a couple of categories. We're going to talk about current assets and current liabilities. That's all. Here's a classified balance sheet. What you've seen before in a balance sheet is this. Come on, come on, come on. Come on, man, where are you? This is what you've seen so far in a balance sheet. A very simple, not itemized format. assets, liabilities, equity. On the classified one, on the classified balance sheet, look at the difference. We're splitting up the assets into current assets, and then they have a category for long-term investments, if you will, plan assets, intangibles. I wouldn't worry about that just yet. But current assets, what is a current asset? We should know it's an asset that's going to be used up within a year, within our operating cycle, within a year. Cash, I mean, you're spending it and collecting it every day. Accounts receivable, inventory, prepaids. Those are your typical current assets. And we're going to isolate them to find out we have 42,900. We're going to do the same thing with the liabilities. We're going to separate current liabilities from the long-term stuff. Current liabilities are those that are due to be paid within, guess, 1 year. Accounts payable, that's classic current liability, wages, unearned, anything that has the word accrued in it. So, classified balance sheet, big deal. We split out the current assets and the current liabilities. And then, yeah, you could have long-term investments. Maybe you bought stock in another company. There's nothing that stops Bill Gates from buying stock in McDonald's if he wanted to on behalf of his company. Plant assets, which is what we were just talking about, the items that you depreciate. And notice they are showing you the original cost of the asset minus the accumulated depreciation. The net book value for that item is 150,200. They have some land. Land does not depreciate. Can you remember that? Land does not depreciate under GAAP accounting rules. It doesn't depreciate. And I think the reason is, land's pretty much been a surefire way to, increase wealth. And there's no real way to measure it until you actually sell it. And then intangible assets. Oh my, we're going to have a chapter on intangible assets. Items you can't even see, but you know they're there. Patents. So, classified balance sheet, current liabilities, long-term liabilities, current assets, plan assets, okay? Classified. Current assets expected to be sold within a year. Let me say that differently. Current assets are expected to be sold, collected, or used within a year. Okay. Sales. Long-term investments go for a long period of time. Plant assets, tangible, long-term assets. Look at that new dump truck we bought out there. Property, plant, and equipment. Intangible, patents, trademarks, copyrights, all kinds of rules about the accounting for these things. Current liabilities, 1 year. Long-term liabilities, multiple years. A mortgage would be a good example, of a long-term liability. What is equity? We've been talking about the accounting equation for a week now. Assets equal liabilities plus equity. Equity, the owner's claim on the assets, it's what the company is worth on paper. It's your assets minus your liabilities. You have a company with $100 in assets and $20 in liabilities. That company on paper is worth $80. And there's no such thing as current or non-current equity. Profit margin, current ratio. Now we get into some good stuff here. Profit margin, current ratio. You're an investor and you might be interested in a company. Maybe you read an article about it in the newspaper and it interested you. These might be two metrics you're going to look at immediately. Immediately. The profit margin. Did we make money? How much? Profit margin. Net income divided by sales, net sales. Simple as that. Net income divided by net sales. Let me call your attention to the bottom here. Visa, current year, Visa. They had income of 12, and that's actually with a B, billion, but we'll let that go for now. 12,080 was their net income on sales of 22,977. So their profit margin was 53%. Boy, wouldn't you like to take, if you had $12,000 today, let me say it this way. If you took a certain amount of money to the bank and left it there for a year or two, would you get 53% back from the bank? No. These people took a risk, started a business. Sales divided by net income, rather, divided by sales, 53%. What that's telling us is that for every dollar of sales that Visa records, they're retaining 53 cents. 53%. That is a mighty handsome looking profit margin to my eyes. And MasterCard's not that far behind. In fact, they seem to be growing faster in terms of this metric than Visa. It was 31, 38, went up 8, went up 9. Profit margin, very important. Okay. One thing that's important with these metrics is that they come out in the form of a ratio or a percentage, which is more useful than hard dollar numbers. It's if you have a company, your company competes with me. You have a $10 million company, and I have a $2 million company. Well, if we compared the dollars, yours is going to always be much bigger than mine. That may not be a fair measurement of the two companies. My $2 million company might be making a margin of 53%, and your $10 million company might be only doing 10%. So the percentages are what you want to use to compare, okay? Here is a super important one. Super important. The current ratio. Current ratio. This is a measurement of your ability. This is a measurement of your company's ability to pay all of its current liabilities if it chooses to do so. And I don't know why they give us these two lousy examples here, but they do. We'll work with them. Costco, 23.4 in assets, 23.2 liabilities. Excuse me. Their current ratio is 1.01. It was 99. It increased to 102. Back down a little bit to 101. What is this telling us? This tells us that for every dollar of current assets they choose to pay off, they'll have a penny left over. In other words, another way to say it, I guess, is your current liabilities are 99% of your current assets. You want to see this number over 1, okay? If it was 2.01, that would be better. If it was 4-1, that'd be good. What if it was 25-1? Did I talk about this at all? What if the current ratio was 25-1? That's really good, right? But do you think that's a good thing for a company to have a current ratio that big? Anybody have any thoughts on that? Bing. The answer is If you've got a big ratio like that, you're hoarding cash. You are hoarding cash when you could hopefully be using it to make more profits. If you got that much of a ratio, why not spend a little money? Why not open up a new store, upgrade your machinery, hire that consultant you've needed? So 3-to-1, 4-to-1, that's plenty good enough. Current ratio. If the number is below 1, like it is with Walmart here, they don't give us the Walmart numbers, but what this means is that Walmart technically is insolvent. It means they don't have the money to pay all their current liabilities right now if they chose to do that. But they're not going to do that. Let me point out also, one thing about Costco and Walmart is they squeeze every penny they can out of their operation. They make their vendors keep their prices low, keep their deliveries on time. Very tough with the dollar. My point being, they can get away with a 101 pretty easily. And that takes us to the end of today's lecture. Any questions, anybody? Hey, Nicole, how you doing? Is Nicole there? Going once, going twice. What do you think, Ebenezer? Any questions?
Not at the moment.
Okay. Yeah, this your experience in 110 should be helpful, I think. We did a lot in this chapter, whether you realize it or not. This is like 2.5 chapters in 110. So we knocked off adjusting entries and closing entries, which are very important. All companies do adjusting entries, and all companies must do closing entries. You're okay, Pam?
Yeah, just trying to absorb everything.
Okay. All right. Well, you know where to find me. You can always, text or email, or if you have a problem with your homework or something. And okay, I guess we'll call it a day, huh?
Thank you so much.
You're welcome, Pam. Bye-bye. Take care,
Bye.
Ebenezer.
Bye. Thank you. You take care.
Bye-bye, Nicole.
Bye-bye, Professor. Thank you.
No questions, Nicole? You're okay?
No, I'm good. Thank you so much. I appreciate it.
Okay.
Okay, have a great day. Thank you.
Yeah, you too. Bye-bye.
Okay, bye-bye.